Hey, are you looking for a place to have longevity and consistency in your investments? Well, check out a potential option as we talk to one of the big cheeses at Invico Capital today. Hey, welcome back to Money Match. I'm Ian Ardill. Today, I am joined together with Jason Brooks, who is the president and co-founder and portfolio manager at Invico Capital. Thanks so much, Jason, for joining us today.
Thanks, Ian. Pleasure to be with you today.
It's been a few years since we've been able to rub shoulders in person, but it's great to be able to do this over the web, and certainly a privilege chatting with you today. First question, for those that aren't familiar with the Invico story, I'm wondering if you can describe for me Invico's mandate, and more specifically, Invico's Diversified Income Fund. What is it? What's the mandate?
Sure, Ian. Happy to do that. So Invico Capital was founded back in 2005. We've strictly been a participant in private capital markets. Obviously, we've worked with you and your father at Raintree for a very long period of time, and with great results. So, the firm is, founded, as I mentioned, in 2005. We've grown ourselves to almost $1.7 billion of assets under management. The flagship fund of the firm is the Invico Diversified Income Fund, and I think that's probably what we're going to talk about most today. And ultimately, the mandate of that fund is to provide and generate tax-efficient yield to our investors. The fund was that fund was launched in 2013. Obviously, we're coming up on 9 years of track record and performance. Never missed a distribution or a redemption. We've been through numerous business cycles over that period of time. So, we are proud of our history and our track record. And, at this time, and obviously speaking with you today, we're celebrating, some very strong results, not only from 2021, but in particular looking forward in our current year, 2022.
Yeah, you talk about business cycles. You've seen your hand, kind of what typically a business cycles might see in 20, 30 years. You've seen it in a fairly short period of time with this particular fund. Lots of ups and downs. Why didn't you see the pandemic coming?
Well, you have to remember the way we built our fund is conservative in nature. So, the one things you can't control are the business cycle that unfolds around you. And, obviously the pandemic was jarring, but, in Invico's history since 2005, we've had the financial crisis. We've had, obviously commodity volatility, never before us like, what we saw obviously in 2020. But now we're seeing obviously, some very strong commodity markets for that portion of the portfolio that's exposed to it. So, when you look at how you manage volatility, and the reason that our products are growing and attractive to investors is that despite that market volatility, we've been able to maintain a base distribution to our investors of better than 7% over that entire period of time. We've often been able to pay out profit sharing, which is again going to commence in 2022, which is very exciting for us. And we've had a stable unit value or net asset values. While they do move a little bit up and down, they've generally been within 10% of our issue price over that period of time. So those are really key attributes. And the reason that the fund has been that sort of steady vehicle over that period of time is that we don't do, we're not an aggressive lender. We have what we call an energy working interest or EWI component of our business, but we are focused on a conservative capital structure. So there's almost negligible debt in the fund. We have over $350 million of unit holder capital, and we only have this very small amount of debt, approximately $10 million of a US facility to help us with matching cross-border currency flows, and a very small facility with ATB in Alberta of about $6 million. So our fund is about doing deals that don't require any financial engineering and just returning the cash flows to our unit holders with as little drag on them as possible, low fees, efficient structures. And the other important attribute, which is unique to the Invico Diversified Income Fund, is we're a relatively tax efficient vehicle. Historically, we've been 50% of our return has been return of capital, which hasn't attracted any tax, and obviously the other half being income. So, I don't need to tell you about the attractiveness of after-tax returns, because at the end of the day, we're all paying tax. So that's a big beneficial.
Yeah, for those of us who are in a higher tax bracket, it's not always what you make, but it's what you keep at the end of the day.
Exactly.
Fair?
That's exactly right. So, across Canada, I mean, I don't think any of us are enjoying really low taxes anymore. I think after the pandemic, the reality is that tax rates will probably continue to move upwards.
So, Jason, there's a couple of things that you highlighted there, and I'm wondering if I can take a little bit of a granular dive on a couple of things. And I'm wondering if I can jump into some of the perceived challenges that you've faced. And I'm wondering if you can speak to something that I saw as a real win, but I don't want to kind of spoon feed you the answer. I noticed that there is an exposure to oil and gas, and certainly that's something you haven't been sheepish about or shy about. There is an exposure or a component of the fund to oil and gas, and in 2020, there was a bit of a retraction there. But I think, everyone gets a little bit nervous anytime there's any kind of retraction. But if you look at the overall diversified aspects of the fund, you still had an extremely rewarding year. I'm wondering if you can talk about that and talk about the value of the due diligence that you put into actually creating that portfolio.
Sure, Ian, that's a good question. I mean, first of all, 2/3 of the portfolio is based on private debt. So, private debt is, obviously we are focused on security, stability of cash flow. Our private debt portfolio, the vast majority of it is in first position, being we have first security against the companies that we're lending to. And in the cases where we don't have a first position, it's in very stable industries like cash flowing real estate properties. So, that's the ballast in the portfolio. It is obviously, performed well over the downturn. Currently in the portfolio, very low default rate, well under 5%. And that's reflective of the quality of underwriting that we had going into the pandemic, because you can't fix loans after they've been made. You really have to make the efforts upfront and put in the right structures and security. So, that's sort of we battle tested that over the pandemic. We're very pleased with the results. And then the other third that you speak of is, yes, we do have within our fund, we have over 1,000 producing oil and gas wells, both in Canada and the United States. So first of all, very important to remember that we have a very diversified portfolio within even that third. And that's, run by very large operators. So most of our operators, if not all of them, are all multi-billion-dollar companies, both in Canada and the US. So it gives us, when you have a very difficult environment like that, it's important to be partnered with very large operators. And, we obviously also employ a risk management program on that side of the business, and that involves hedging. So, we all famously remember the negative oil and gas pricing. In our case, we skated over the worst of that because we had hedges in place that allowed us to continue to generate cash flow. Obviously, the cash flows declined in that time. But the other thing that I mentioned earlier, Ian, is that we don't use meaningful amounts of debt in the portfolio. So, that allowed us at that time to, manage ourselves, unit holders, and remain in control of your assets. We're not exposed to meaningful debt, such that we would have had a problem where we obviously had to go into some kind of a forbearance or anything with a bank. So it's important to conservatively finance yourself, because you do not know what the future holds. And then you're in a cyclical business like energy, that holds doubly. And unfortunately, a lot of energy companies are not financed conservatively. They do use quite a bit of debt. It's kind of a public market space where a lot of debt capital markets are far cheaper than equity capital markets. So in our case, we're just looking to the economics of the assets without having to do anything further to get that into the hands of our unit holders.
Well, listen, Jason, as a huge compliment, I really believe that you guys have done an excellent job at capitalizing on that word in the name of your fund, diversified. You really have created this incredible diversified basket of what I'd call sub-securities or like construction inside your portfolio that, even in the downturn of some of the more challenging months when there was negative oil prices, you protected your bottom line, and you ultimately protected investors in their overall exposure of and any of your underperforming assets, simply because you diversified and built a beautiful portfolio. And so just for the listeners who aren't familiar with your portfolio in terms of returns, in 2020, when you had that bit of retraction, you still had a positive year. Fair?
Yes, we did, Ian, and we maintained our distributions to unit holders through that entire period of time. We had a positive return experience. When you really look at the return since that dip, obviously, that we all experienced, we've earned both our base distribution, and we've had also increases in our unit value over that period of time. And total returns are some 13% annual. So for an income product, that's a good performance over a difficult period. And it is because of the diversification. It is because of risk management, conservative capital structure. It's really a pancaking of features that allows our unit holders to feel comfortable that we are not out there swinging for it. Which might look good in really strong, robust markets, as we've all seen since the pandemic. There's been tremendous returns available, but the important thing is when you look at those down dips and those drawdowns in our volatile world that we live in, how you perform over that period of time is really the differentiator.
Well, and I guess from an outsider looking in, I think one of the best differentiators that Invico has is not just the fact that you're so good looking, Jason, but you're
both, Ian.
You've got an incredible bench strength at Invico. I'm wondering if you can comment on the management facilities at Invico.
Yes, absolutely, Ian. I mean, we've obviously, as I mentioned, we've been around since 2005. So we have built out a team over many years. This is a battle-hardened team. We've added a chief investment officer, Chris Wotsky. We have, an individual who handles a lot of our very active investments in David Hawkins. He's had a ton of experience. Obviously, my partner, Allison Taylor. And then in addition to that, there's some 40 people that work in Invico, and a good half of them are, fully dedicated to the investment management side of the business. So ultimately, for us, the bench strength's important. In the energy business, it is a technically driven business. We have some of the best technical people in the world in Canada, and particularly in Calgary. So we're very lucky in having that talent pool to be able to access. And we did that. We did, years ago, we've been adding professional engineers, land professionals into that side of the business so that we have the technical capability to look at those opportunities, assess them, and do proper environmental analysis as well before we're making investment decisions.
So I obviously past performance is no guarantee to future performance. But if somebody was looking at and making an investment in Invico today, over a 3 to 5 year time horizon, what do you think they could anticipate from a return perspective?
Yeah, so Ian, obviously, as we pay out a base distribution of approximately 7%. That's been consistent and maintainable over, obviously, the track record of the fund. our investment strategies haven't really changed. So, we're continuing to build ourselves to maintain that. On a 3 to 5 year time frame, obviously when we're in a cycle where we are today, and somewhat difficult situation in the world, but inflation is high. We have commodity exposure in our fund, which has been a very good hedge against inflation. In fact, it's added a considerable amount of income with the energy sleeve in the portfolio. So this year, as I mentioned earlier, we're looking at paying out special distributions above the base rate. And while I don't have an idea right now, typically in the past, our fund over the good times has been able to add 2 to 3 percentage points of upside in a market where we haven't seen even commodity prices this high. So we're looking to provide some future special distributions. It will continue as long as the performance is there to justify it. But we're not changing what we do. It's still, we're still managing ourselves to, conservatively to maintain our future, health and longevity. I mean, everyone that, we're very fortunate to have a large and growing capital base and unit holders. We have a lot of dedicated people. Nobody should be considering this product for short periods of time, 6 months a year. We're really driven to perform over, this, 3 to 5 years for sure, as you mentioned. So, we're looking to, maintain high single digits over a cycle, and potentially even a little bit above that if things, stay really good.
Well, thank you, Jason. So let me ask you this as a close-off question. If you're riding in an elevator and somebody just came up to you and asked you, just in a summary, a sentence or two, why Invico? Well, why should somebody trust their money to Invico?
Sure. I mean, we've created a culture of performance here, but overlaid with conservative principles to ensure that, we're battle tested. I mean, we're in private capital markets. We've been here for a long time. Yes, we're in cyclical markets, but we manage them well. We have the track record to return a very good yield to our unit holders in a tax efficient way. And I haven't been in a lot of elevators lately due to the pandemic, so that's probably not the best elevator speech, but I'll tune it up now that we can all get in elevators. But we are definitely in the private capital markets. We have been recognized as well in the Canadian Hedge Funds Award, placing second in both the 3-year and 5-year return. So that's in private debt. So we're also proud of our, the accolades we've received from industry. And we're a unique firm. We're over 60% women in this firm. So when people think about ESG, always remember the S and the G. I think a lot of people forgot that in the world, and they really matter because we are focused on the whole package here, not just the bottom line financial return.
Jason, thank you so much for your time today. For more information, you can always check me out at ardillgroup.com, and I'll link to some of Invico's resources on the bottom of the show notes. Thanks so much again, Jason, for joining me today.
Thank you, Ian, and thanks again to Raintree for your support over the years.